paper presenter. This is Santosh Koirala, speaking on corporate governance reforms and dividend policy, the importance of personal liability in enforcement.
Good afternoon, all. Foremost, thank you to IGIDR for giving me this opportunity to be here and present our working paper, which I co-author with my two of my supervisors, and that becomes even more important when I am in my final year of my PhD and I'm in the job market. So especially the grant part, which I can add to my CV, becomes very important. So here in this paper, what we do is we see the relationship between firms' dividend policy, the payout policy, and corporate governance, and we test this substitution hypothesis. That is what we call for the substitution between dividend payout and corporate governance, if one is convinced to believe that these two substitutes each other in the first place. So our motivation has been, so we argue that dividend payout is one way through which a firm can communicate that, okay, the agency, you are well, the minority shares are well taken care of, we pay you, so don't worry, we are good firm. However, and this brings the reputation of being fair to minority investors, and few papers has documented that this relation becomes important when it comes to emerging market, and this translates to higher market valuation as shown by research by Pinkovich et al. However, as we know, for a growth-oriented company, dividend payout can be at times costly. They are in a way good to communicate, but they can be a costly strategy. So, alternatively, mandatory corporate governance reforms can do away with these agency problems through better independence, better transparency. So what we argue is there should be a level of substitution between corporate governance reform or regulation and a dividend payout policy. So here we are, we use DPR and dividend payout or dividend policy, interchangeably. So why, then the second question becomes why emerging market? The argument we put forward is given this, the higher agency problem between the minority outsiders and powerful controlling insiders, this market becomes an ideal setup to test whether there is some kind of substitution between these two variables. And this question may be important, especially important when I pitch my paper to potential journal referees. Why India? So our argument would be this gives us an ideal setup to test, in addition to test this substitution hypothesis, it allows us to see this, the adequacy of sanctions, the adequacy of punishment, if you like to call it, is the adequacy of sanction an important factor when it comes for corporate governance to have some material effect on corporate decisions, and here our variable is a dividend policy. So this setup has previously been used in journals of law and finance. So I will take you back to arguably the first formal corporate governance regulation in India, which is clause 49 of 2000. So this was the first, this was the improvement in listing agreement, which SEBI introduced in the year 2000. There was a series of debt event for which firms would be affected by when. So as you see, in March 2001, this was applied to a very large company, which is companies which would be companies listed under flag A listing in BSE Bombay Stock Exchange. In the year 2002, the mid-cap companies would be affected, and in the year 2003, the group 3 firms, which is small cap company, would be affected, and any company below the paid up capital of 30 million INR would not be affected by this regulation. However, on October 12, 2004, there was an addition to the Securities Contract Act. With the addition was Section 23E, which imposed significant criminal and financial liabilities to the corporate insiders for if in the case of non-compliance. So to us, this expands the personal liability dimension and introduces harsher sanctions in addition to previously in this, as per 2000 regulation, the penalty was more like reputational, where the stock would be delisted if you were found not complying with the regulation. So let me jump to two hypotheses we use here. First is since this was the first formal major corporate governance reform, this should have some sort of substitutive effect on companies' payout policy, given that the substitution argument holds. So should make the reputational rule of dividend policy less effective. So what we say is the affected firms would have more reduction in the dividends payout in comparison to those who are not affected by the regulation. However, we see we test the argument on the adequacy of reform, where the expansion of personal liability that was in the year 2004 had some implication on the substitution of corporate governance, substitution of DPR by corporate governance. So what we posit or what we argue is the substitution would only materialize when there is, in addition to the reputational penalty of delisting, it expands personal liability of insiders in the case of non-compliance. So the adequacy of punishment works better for having positive effect on complying behavior. So here I present some the univariate stats. So this is 3 years before and 3 years after, when a particular group of firm was affected by clause 49 in panel A and was affected by this sanction in panel B. So what we see is there is no statistically significant, economically meaningful change in dividend payout ratio in the first event, which is the introduction, whereas you can see a good decline in dividend payout, and which is meaningful in economic sense following this expansion of personal liabilities. So to add to our multivariate, we run this multivariate regression in diff model, where we do take care of various controls that would compete with our main argument, and we can see that the effect is consistently negative and in a meaningful way only for the reform in 2004 and not when it was in 2000 and in the year 2000. Basically, that is what we call the effect of expanding personal liability in the sanction. So, what we also do as a further robustness check, let me just highlight this. You see this size is also explaining most of the variation. Size has been a significant factor because the whole reform was based, the applicability of reform was based on the size of firms. So, that do play do explain some part of the story. So, we should take care of this, which we do by a kind of matching also, and following that we do some false experiment test where we do take false event and see the before and after and whether the substitution argument holds in that false experiment. We narrow our study period for a year for 2003 to 2006 to see whether it holds for a narrow period. We also do this first difference regression if it has to tell some story, and we do take care of some selection bias story. So, what we see is okay, the table has not been presented here, but our inference is robust to different robustness checks, including matching and false experiment and for a narrow period, and with all the alternative specification like first difference regression. Just 1 minute I would like to, so what we did to see who are these firms who are reducing their dividend payout following 2004. To see this, what we did was we classified the firms into two categories, high dividend paying, the upper tertile, and low dividend paying, lower tertile before 2004, and see that the effect of substitution worked more for those firms who were paying high dividends. So, a story in line with what we argue, and also the dividend reduction was significant for those firms who had a higher stake of creditors prior to 2004. So, creditors would benefit from this reduction in dividend following better corporate governance environment in the firm. Yeah, that would end my part of presentation.
Poonam, you have 10 minutes.
Good afternoon, everyone. Thank you, Santosh, for the paper. So I'll just, sorry, I didn't make slides. So first part, so about the paper now. So this is, so far as the econometrics of this paper is, concerned, what we find is they have a nice exogenous event, which is our clause 49, and this takes care of, many of the problems that this corporate governance research faces. So that endogeneity problem being taken care of with DID and an exogenous event to start with. And like we had an offhand chat, so from where I know that this is his first conference, but from the on this paper, but the paper looks pretty clean and has touched upon many of the aspects. I have a couple of observations with respect to the pre-econometrics part, which is how the hypothesis is developed and so on and so forth. So the first thing is that this paper tries to test the substitution argument between the dividend payout ratio and corporate governance, a better corporate governance mechanism. So my comment there is probably it's better because there is an alternative complementary argument which also is available in the literature, which says that better corporate governance leads to a better dividend payout ratio. So rather than starting with an assumption of substitution between corporate governance and dividend, it's better to motivate the theory with both the substitution and complementary argument in place, and then either through theory or through the empirical validation show that there is a place for substitution. Otherwise, I think this would create some problems. The second is, this point is touched upon. This is a period which coincided with the dividend distribution tax being introduced in the Indian setup. And while the paper touches on it and says that both the control and experiment group would be kind of similarly impacted by it, I would kind of beg to differ on this. And the reason for that is that this dividend distribution tax, although it was introduced in 1997, it has had a lot of changes across this period. Like in 2002, it was abolished for some time. 2004, it was reintroduced. There were many changes. Like every now and then budget, there has been some change. And it's better to empirically account for it and rule out, if that is so, that this is not having an impact. Because my hunch is that the control and the experimental group would be differentially impacted by these changes in the dividend distribution. Now, drawing from there, the third point is with regard to, so we know, like there is again a literature which says that enforcement in developing countries is weak. So if you compare, say, enforcement for DDT kind of thing vis-a-vis enforcement of corporate governance, probably the certainty is higher in case of DDT rather than, so if we expect firms to kind of respond so much to a personal liability kind of enforcement, then probably DDT, we would expect them more, because you have declared dividend, you have to pay tax for that. And that increases your cost. So so hence, that weak enforcement kind of weakens the second hypothesis that one sees. The fourth argument is, so one of the points in the paper is that the whole dividend payout is a costly mechanism. So then the question is that, so, and especially, this is especially true during the 1997-2000 period, when there were a lot of these firms which were adopting voluntary corporate governance codes, right? So that was very much there. There are a lot of committees being formed, and we have this whole Infosys literature and so on. So there again, so if dividend was costly to begin with, why wouldn't a firm go for a voluntary corporate governance code rather than going for dividend distribution, and why it requires a say like compulsory code to come in to make them kind of substitute it with substitute basically the dividend with the corporate governance thing. So that is something again the paper should address. And lastly, I think again India, because this is a work on Indian corporate governance with all this family firm and all that, gives you further rich ways to kind of dissect this. This could possibly be an extension because there is already a lot in it. So that allows you to further explore the data. Yeah, thank you. That was all. Thank you so much.
Are there any questions from the floor? So Santosh, do you want to respond to?
Yeah, I am mainly you made 5 comments. My work in progress project is on this DDT. So I, at least I can tell you that my story, our story on substitution holds with but I should make it more explicit in the paper. I do take that. We need to think on. You are right in. We need to, put more light on this alternative explanation of a positive relation between CG and dividend. But the fact that that would enrich, even that would make the question even interesting to test. Only fact I would like to admit here would be, even DPR was falling in the post 2004 period, there was higher valuation of this firm, so the lowering of dividend was not affecting the firm's value, which in prior to the 2004, higher DPR was associated with high firm value, so that would make my story a bit stronger. I am not sure how I should address this voluntary codes. Maybe an acknowledgement of this would be what I can do at most at present, but I'm not aware of empirical way to address this in my paper. Yes, I really appreciate, I can look into this direction of family firms as I move along with the paper. Thank you.
Thank you, Santosh. So we have a coffee break now, and we come back here at 3:15 for the next session. Thank you.